Ready to pass the CPA exam faster? Visit cpapass.ai. Today, LIFO to FIFO change. Master FAR accounting principle rules. Consistency is the bedrock of financial reporting, allowing investors and regulators to compare a company's performance over time. On the FAR section of the CPA exam, mastering how to handle changes in accounting principles is critical. When a company changes its accounting methods, it must balance the need for better reporting with the demand for consistent, comparable financial statements. This lecture provides a clear roadmap for navigating these rules. We will define what constitutes a true change in principle, explore the FASB mandate under ASC 250, walk through retrospective adjustments, and highlight the exact traps examiners use to test your knowledge. To master this topic, you must first understand what a change in accounting principle actually is. Under ASC 250, a change in principle occurs when a company switches from one acceptable GAAP accounting method to another acceptable GAAP method. A classic example is switching an inventory valuation method from LIFO to FIFO, or from FIFO to weighted average. Both methods are fully permitted under GAAP, but the company chooses to change. Be highly alert to a critical distinction that examiners love to test. A change in principle is not an error correction. Switching from an unacceptable non-GAAP method to an acceptable GAAP method is always treated as an error correction, which requires a restatement, not a change in principle. Historically, there are three theoretical approaches to reporting accounting changes: prospective, current, and retrospective. However, to ensure financial statement comparability, FASB's ASC 250 mandates a single approach for changes in accounting principle, the retrospective approach. Why does FASB require this? Because comparability is vital for investors. If a company presents 3 years of comparative financial statements, but uses LIFO for 1 year and FIFO for the other 2, investors are comparing apples to oranges. By requiring retrospective application, FASB ensures that all comparative periods presented are adjusted to reflect the new principle. Remember our memory trick. Principles look backward and require a rewind, whereas estimates look forward. Only estimates are handled prospectively. For a change in principle, we must go back and rewrite history. Applying a change in principle retrospectively involves a systematic 3-step process. First, you must restate all prior period comparative financial statements presented in the current report. This means recalculating prior numbers as if the new method had always been used. Second, you must determine the cumulative effect of the change for all periods prior to those presented. Third, you adjust the opening balance of retained earnings for the earliest period presented. This adjustment is made net of tax and acts as the catch-up mechanism. By adjusting the opening retained earnings balance, the cumulative effect of the change prior to the comparative years is properly absorbed without distorting the current year's income statement. This clean separation of past and present is a major focus on the CPA exam. Let's walk through a practical example to see these mechanics in action. Suppose ABC Company decides to switch its inventory valuation method from LIFO to FIFO in 2024. The company presents comparative financial statements for 2022 and 2023. The cumulative effect of switching to FIFO for all years prior to 2022 is calculated to be $30,000. To account for this change, ABC must take 2 primary actions. First, it must restate the comparative financial statements for 2022 and 2023 using the FIFO method. Second, ABC must increase the opening balance of retained earnings on January 1st, 2022 by $30,000 net of tax. This adjustment ensures the comparative statements are perfectly consistent and the pre-2022 cumulative impact is correctly reflected in equity. To wrap up, let's look at disclosures and key examiner traps. Under ASC 250, companies must disclose the nature of, justification for, and quantitative impact of the change in principle. On exam day, watch out for 2 major traps. First, do not apply prospective treatment. Prospective application is strictly reserved for changes in estimates. Second, never run the cumulative effect of a principal change through the current year's net income. It must adjust the opening balance of retained earnings for the earliest period presented. To practice these concepts with realistic simulations and multiple choice questions, head over to cpapass.ai to solidify your understanding and guarantee a passing score.